Look, I need you to understand something that most people are going to miss completely. We're standing at one of those rare moments in financial history where everything is about to change, and the window to position yourself is closing faster than anyone realizes. Gold just crossed $4,300 per ounce. Silver shattered its all-time high, blowing past $64. And here's what nobody's talking about. This isn't the top. This is the beginning of something much, much bigger. Let me show you what's really happening behind the scenes, because the story the mainstream media is telling you is incomplete at best and deliberately misleading at worst. Right now, as you're watching this, there's a massive shift occurring in the global financial system. Central banks around the world are accumulating gold at a pace we haven't seen in over 50 years. We're talking about hundreds of tons being purchased every single quarter. China, Russia, India, Turkey, Poland. These aren't small players making emotional decisions. These are sophisticated institutions with access to information and analysis that would make your head spin. And they're all doing the same thing. They're converting their dollar reserves into physical gold as fast as they possibly can. Now, why would they do that? Why would central banks, the very institutions that are supposed to maintain confidence in fiat currencies, be dumping those currencies for a barbarous relic that supposedly has no place in the modern financial system? Because they know something. They've run the numbers. They've seen the debt levels. They've watched the money printing. And they've come to a conclusion that should terrify anyone holding significant wealth in paper assets. The dollar-based system as we know it is reaching its mathematical limits. Think about this for a second. The United States has over $36 trillion in official debt. That number is growing by roughly $1 trillion every 100 days. Every single day, the government has to pay over $2 billion just in interest on that debt. Not paying down the principal, just the interest. And here's where it gets really interesting. To service that debt, to keep the lights on, to fund all the programs and promises that have been made, there's only one option left: print more money, create more dollars out of thin air, expand the money supply. But every time you do that, every time you create new currency units without creating new value, you dilute the purchasing power of every dollar already in existence. You're essentially stealing from everyone who holds dollars, slowly and quietly, through the invisible tax of inflation. Now, the Federal Reserve will tell you they have everything under control. They'll show you their models and their projections. They'll talk about their dual mandate and their sophisticated tools. But here's what they won't tell you. They're trapped. If they raise interest rates to fight inflation, they collapse the economy and make the debt unsustainable. If they lower rates or keep them low, they fuel more inflation and destroy the currency's purchasing power. There's no good option. There's no painless way out. And the smart money knows this. That's why you're seeing this unprecedented accumulation phase in precious metals. Let me paint you a picture of what's happening in the physical market right now, because this is where the real story is unfolding. The COMEX, the major commodities exchange where gold and silver futures are traded, is showing something remarkable. The amount of physical metal available for delivery is dropping to critically low levels. We're talking about inventory levels that, if current trends continue, could be completely depleted within months. At the same time, the premiums on physical metal, the amount you have to pay above the spot price to actually get your hands on real gold or silver, are exploding. In some markets, you're paying 10%, 15%, even 20% over spot just to get physical delivery. What does that tell you? It tells you there's a massive disconnect between the paper price and the physical reality. It tells you that the people who actually want to own the metal, who want to hold it in their hands, are willing to pay significantly more than what the futures market says it's worth. This is the setup for what's called a short squeeze. And if you understand how these work, you know they can be absolutely explosive. Here's the mechanism. For decades, large banks and institutions have been selling paper contracts for gold and silver, promises to deliver metal at a future date. They've sold far more contracts than there is actual physical metal to back them up. This works fine as long as most people are content to just trade the paper back and forth, as long as they don't actually demand delivery. But what happens when that changes? What happens when buyers start saying, "No, I don't want your paper promise. I want the actual metal"? The sellers have to scramble to find physical metal to deliver. They have to go into the market and buy. And when there's not enough supply to meet that demand, the price doesn't just go up, it explodes. We saw a preview of this in the silver market recently. The price shot up over 10% in a single week. That's not normal market movement. That's the beginning of a squeeze. And here's what makes this situation even more critical. The industrial demand for silver is absolutely skyrocketing. Solar panels, electric vehicles, 5G infrastructure, medical applications, all of these technologies require silver, and they require a lot of it. We're talking about hundreds of millions of ounces being consumed every single year just for industrial purposes. And unlike gold, which is mostly recycled and stays in the financial system, silver gets used up. It gets consumed in tiny amounts across millions of products, and it's not economically viable to recover it. So, you have this situation where industrial demand is eating up supply, investment demand is surging, and the available inventory is shrinking. It's a perfect storm. Now, let me take you back in history for a moment, because understanding what happened before gives us a roadmap for what's coming next. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold, effectively ending the Bretton Woods system and ushering in the era of pure fiat currency. What happened next? Gold went from $35 an ounce to over $800 by 1980. That's not a 2x or a 3x. That's a 23x increase in less than a decade. But here's what's important to understand. It didn't happen all at once. There were phases. There was an initial surge as people realized the dollar was no longer backed by anything. Then there was a consolidation period where the price moved sideways and people thought maybe it was over. And then came the real move, the parabolic phase where gold went from $200 to $800 in just a few years. We're seeing the same pattern now. We had the initial surge from 2019 to 2020. We had the consolidation from 2021 to 2023. And now we're entering what could be the parabolic phase. Some analysts are projecting gold could hit $5,000 per ounce within the next year or two. And honestly, based on the fundamentals, based on the debt levels, based on the money printing, that might be conservative. Think about what gold at $5,000 means. If you're holding physical gold right now, that's a 15% to 20% gain from current levels. But more importantly, it's wealth preservation. It's maintaining your purchasing power while everything else is being devalued. And silver? If silver just returns to its historical ratio with gold, which has averaged around 15 to 1 over centuries, we're talking about silver at $300 per ounce or higher. From current levels around $64, that's a potential 4x to 5x move. Now, I want to address something important here, especially if you're someone who's been saving for retirement, who's built up a nest egg in traditional retirement accounts. You've done everything right. You've been disciplined. You've contributed to your 401k or your IRA year after year. You've watched that balance grow. And now you're sitting on maybe $100,000, maybe $500,000, maybe more. But here's the question you need to ask yourself. What is that money actually denominated in? It's in dollars. And if those dollars are losing purchasing power, if inflation is eating away at the real value of your savings, then that number on your statement doesn't mean what you think it means. This is where a lot of people are looking at gold IRAs, a way to get physical precious metals into their retirement accounts without triggering taxes or penalties. I put together a free guide on how this works, how the process actually functions, what the rules are. It's in the description below if you want to check it out. No pressure. But if you're sitting on significant retirement savings, it's worth understanding your options. All right, back to where this market is headed, because there are some specific catalysts coming that could accelerate this move dramatically. First, there's the geopolitical situation. We're seeing a fundamental realignment of global power structures. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternatives to the dollar-based system. They're setting up their own payment systems, their own trade mechanisms, their own reserve arrangements, and at the center of all of this is gold. They're talking about gold-backed trade settlements. They're talking about using gold as a neutral reserve asset that no single country controls. Now, the Western media likes to downplay this. They'll tell you it's not a serious threat, that the dollar's dominance is secure. But actions speak louder than words. And the actions of these nations, the gold buying, the bilateral trade agreements, the infrastructure being built, tell a very different story. Second, there's the debt spiral I mentioned earlier. This isn't a problem that's going away. It's getting worse every single day. And at some point, the market is going to demand a higher interest rate to hold U.S. debt. They're going to look at the risk and say, we need to be compensated more for this. When that happens, when yields start spiking, the Federal Reserve will have a choice. Let the government go bankrupt trying to service the debt at higher rates, or step in and buy the bonds themselves, printing whatever money is necessary. We already know which option they'll choose. They've told us. They've said explicitly that they will do whatever it takes to maintain financial stability. And whatever it takes means printing money. Third, there's the physical supply situation. Mining production for both gold and silver has been relatively flat for years. It's not easy to just open up new mines. It takes years of exploration, permitting, development, and the easy deposits have already been found and mined. Meanwhile, demand is surging. You have central banks buying, you have retail investors buying, you have industrial users buying, and you have a growing awareness among the general public that something is fundamentally wrong with the monetary system. When supply is constrained and demand is increasing, there's only one direction for price to go. Now, let me address the skeptics for a moment, because I know there are people watching this who are thinking, this sounds too good to be true. This sounds like fear-mongering. Gold and silver have been about to explode for years, and it never happens. And you know what? That's a fair point. There have been a lot of false alarms. There have been a lot of people crying wolf. But here's the difference. The fundamentals have never been this extreme. The debt has never been this high. The money printing has never been this aggressive. The central bank buying has never been this intense. The geopolitical tensions have never been this severe. This isn't speculation. This isn't theory. This is observable reality. You can look at the numbers yourself. You can see the central bank purchases. You can see the COMEX inventory levels. You can see the premiums on physical metal, the accumulation phase, the period where smart money quietly builds positions before the general public catches on, is ending. We're transitioning into the awareness phase, where more and more people start to understand what's happening and rush to get positioned. And once we hit the mania phase, once the general public is scrambling to buy precious metals, the prices will be multiples of where they are today. Let me give you a specific example of how fast things can move when sentiment shifts. In 2008, during the financial crisis, gold was trading around $800 per ounce. People were scared. The banking system was collapsing. And within 3 years, by 2011, gold had nearly tripled to over $1,900. But here's what's important. The people who made the most money weren't the ones who bought at $1,800 hoping to catch the last 10%. They were the ones who bought at $800, $900, $1,000 when everyone else was still skeptical, when the mainstream media was still saying gold was a barbarous relic with no place in modern portfolios. They accumulated during the phase when it was unpopular, and they were rewarded when sentiment shifted. We're in a similar moment right now. Yes, gold and silver have already moved significantly, but relative to where they're going, relative to the fundamentals, we're still early. Think about it this way. If gold goes to $5,000 or $6,000, buying at $4,300 versus $4,000 isn't going to matter much. You're still going to do extremely well. But if you wait until gold is at $5,000 and everyone is talking about it, and then it goes to $6,000, you've missed the majority of the move. The time to position yourself is when you still have to explain to people why you're doing it. The time to act is when it still feels uncomfortable, when you're going against the crowd. And right now, despite the recent moves, we're still in that window. The general public is not piling into precious metals. Your neighbors aren't talking about gold and silver at dinner parties. CNBC isn't running 24/7 coverage of the gold market. But they will be. And when they are, it will be too late to get positioned at reasonable prices. Now, let's talk about the practical implications of all this, because understanding the macro picture is one thing, but you need to know how to actually protect yourself and potentially profit from what's coming. First, understand that this is not about getting rich quick. This is about preserving wealth and maintaining purchasing power in an environment where the currency is being systematically devalued. If you have $100,000 in cash sitting in a bank account and inflation runs at 7% to 10% per year for the next 5 years, you're going to lose 30% to 40% of your purchasing power. That $100,000 will only buy what $60,000 or $70,000 buys today. But if you convert some of that into physical gold and silver, you're protecting yourself. You're maintaining your purchasing power. And if the metals appreciate significantly, which all the fundamentals suggest they will, you're actually growing your wealth in real terms. Second, understand the difference between paper and physical. There are a lot of ways to get exposure to precious metals, ETFs, mining stocks, futures contracts, and some of those have their place, but nothing replaces physical metal in your possession. When you own physical gold and silver, you own an asset that has no counterparty risk. You're not dependent on a bank staying solvent. You're not dependent on a company honoring its obligations. You own the actual metal. In a real crisis scenario, that distinction becomes critically important. Paper promises can be broken. Physical metal cannot. Third, understand that this is a process, not an event. You don't have to go all in tomorrow. You don't have to bet everything on one outcome, but you do need to start taking action. Maybe you start by converting 10% or 20% of your liquid savings into physical metals. Maybe you look at your retirement accounts and explore options for diversification. Maybe you start dollar cost averaging, buying a little bit every month regardless of price. The key is to start. The key is to stop waiting for the perfect moment, because the perfect moment is always in hindsight. Let me share one more historical parallel that I think is really instructive. In the late 1970s, there was a period where gold and silver went absolutely parabolic. Gold went from $200 to $800 in just a couple of years. Silver went from $5 to $50 in an even shorter time frame. And during that run, there were multiple pullbacks. There were moments where the price dropped 10%, 15%, even 20%, and people thought the move was over. They thought they'd missed it or that it was time to sell. But the people who understood the fundamentals, who understood that the underlying drivers hadn't changed, they held on. They bought the dips, and they were rewarded with the final parabolic move that took prices to levels nobody thought possible. We're going to see the same thing this time. There will be volatility. There will be pullbacks. There will be moments of doubt. But if you understand why you own precious metals, if you understand the fundamental case, those pullbacks become buying opportunities, not reasons to panic. The monetary system is broken. The debt is unsustainable. The money printing is accelerating. Central banks are accumulating gold at record pace. Physical supply is tightening. Industrial demand is surging. Geopolitical tensions are rising. All of these factors point in one direction: significantly higher prices for gold and silver. The question is not whether this is going to happen. The question is whether you're going to be positioned for it when it does. Right now, you still have time. The accumulation phase is ending, but it hasn't ended yet. You can still buy physical metal at reasonable premiums. You can still get positioned before the general public catches on. But that window is closing. Every day that passes, more people wake up to what's happening. Every day, more capital flows into the precious metals market. Every day, the available supply shrinks a little bit more. This is not a drill. This is not fear-mongering. This is observable reality backed by data, by central bank actions, by market dynamics. The institutions are positioning themselves. The smart money is accumulating. The question is, are you? Because when this really takes off, when we enter the parabolic phase, the gains are going to be extraordinary. But more importantly, the wealth preservation is going to be critical. Your dollars are losing value every single day. Your purchasing power is being eroded by inflation that's running far higher than official statistics suggest. Your retirement savings, your life's work, is denominated in a currency that's being systematically devalued. Gold and silver are not just investments. They're insurance. They're a hedge against monetary chaos. They're a store of value that has survived every currency collapse, every empire's fall, every financial crisis in human history. And right now, at this moment in time, they're telling us something. The price action, the central bank buying, the physical premiums, the supply constraints, they're all telling us the same thing. The time for accumulation is ending. The next phase is beginning. And if you're not positioned, you're going to watch from the sidelines as one of the greatest wealth transfers in history unfolds. Don't let that be you. Don't be the person who understood what was happening but failed to act. Don't be the person who looks back in 2 years and says, I knew this was coming, but I didn't do anything about it. The information is out there. The data is clear. The fundamentals are undeniable. Now it's up to you to make a decision. Are you going to protect your wealth? Are you going to position yourself for what's coming? Or are you going to hope that somehow, magically, the system fixes itself and everything goes back to normal? Because I can tell you right now, it's not going back to normal. The old normal is gone. We're entering a new paradigm, and the people who recognize that early, who adapt and position themselves accordingly, are going to be the ones who preserve and grow their wealth. The liftoff is beginning. The question is whether you're on board.